Hello, friends. If the market is in an uptrend and the price starts pulling back, one question comes to almost every trader's mind. Is this just a pullback or is there reversal? This is where the Fibonacci Retracement tool becomes incredibly useful. Fibonacci Retracement is a powerful tool that helps us identify whether the current move is just a temporary pullback or a potential trend reversal. It also helps us find high probability entry points, place stop losses, and set profit targets. However, most beginners use Fibonacci the wrong way, and when the trade goes against them, they say Fibonacci doesn't work. But the truth is, the problem isn't the Fibonacci tool. The problem is how it's being used. So in today's video, we'll go through everything step by step. We'll understand what is Fibonacci retracement, how to draw it correctly on the chart, which Fibonacci levels actually matter, and most importantly, how professional traders use it to find high probability entries and exits. We'll also cover some common mistakes that almost every beginner makes. So let's get started. First of all, let's understand what Fibonacci retracement actually is. In simple terms, Fibonacci retracement is a tool that helps us estimate how far the price is likely to pull back after making a strong move. The market never moves in a straight line. If the market is moving up, it will pause and pull back before continuing higher. Similarly, if the market is moving down, it will often bounce before continuing lower. These temporary moves are called pullbacks or retracements. Fibonacci helps us identify the areas where these pullbacks are most likely to end and where the original trend has a higher chance of continuing. That's why professional traders don't use Fibonacci to trade against the trend. Instead, they use it to find better entries in the direction of the existing trend. Now let's understand the correct way to draw Fibonacci on the chart. Fibonacci should only be used when the market is clearly trending, either in an uptrend or a downtrend. One important rule to remember is that you should never use Fibonacci in a sideways or range-bound market. You've probably heard the phrase, "The trend is your friend." Trading with the trend generally gives you a much higher probability of success. But many traders don't know how to actually trade with the trend. This is where Fibonacci becomes extremely useful. With a single tool, you can identify potential entry zones, stop loss placement, and even profit targets. To use it, open TradingView and select the Fibonacci retracement tool from the toolbar on the left side. If the market is in an uptrend, draw Fibonacci from the swing low to the swing high. This is default setting. You'll see many Fibonacci levels on your chart, which can be very complex for you at first. The good news is that you don't need all of them. Open the settings and remove the unnecessary levels. Delete the 0.382 level. Then remove all the extension levels above 1 except 1.618. Also remove 0.236 and 0.786. Now you'll be left with only 5 important levels: 0, 0.5, 0.618, 1, and 1.618. If you want a cleaner chart, you can also remove the background shading. Now your Fibonacci setup becomes much simpler and much easier to read. Drawing Fibonacci is actually very simple. Suppose the market is making higher highs and higher lows, which means it's in an uptrend. In that case, draw Fibonacci from the swing low to the swing high. When the price pulls back, these Fibonacci levels often act as support. Now let's look at the opposite scenario. If the market is in a downtrend, draw Fibonacci from the swing high to the swing low. As the price retraces upward, these Fibonacci levels can act as resistance. That's the correct way to draw Fibonacci retracement. Now let's move to the most important part of this video: how to use Fibonacci for planning your entries and exits. There are 2 ways we use this tool. The first is Fibonacci retracement, which helps us find potential entry points. The second is Fibonacci extension, which helps us identify possible profit targets and exit levels. Let's start with Fibonacci retracement. In an uptrend, draw Fibonacci so that the 1 level is at the swing low and the 0 level is at the swing high. Between these 2 points, there are 2 very important levels: 0.5 and 0.618. Out of all the Fibonacci levels, the 0.618 level is considered the most important. It's also known as the golden ratio. This is the level where professional traders often look for entries because historically it has offered some of the highest probability setups. Remember, the market never moves in one direction forever. It rallies, pulls back, rallies again, pulls back again, and continues this cycle. That's simply how market structure works. Professional traders take advantage of these pullbacks instead of chasing the price. When the price retraces into the area between the 0.5 and 0.618 levels, wait for additional confirmation. For example, if you see a bullish engulfing candle or a hammer candlestick pattern, that can indicate buyers are stepping back into the market. Once the confirmation candle closes, you can consider entering a buy trade. Your stop loss should be placed below the recent swing low. If that swing low breaks, it could be an early sign that the trend is weakening, reversing, or moving into a sideways phase. That's how Fibonacci retracement helps us find high-quality entries. Now let's understand Fibonacci extension, which we use for planning our exits. Fibonacci extension helps us identify potential resistance levels where the market may slow down or reverse, allowing us to lock in profits before that happens. To find these levels, we need to draw a Fibonacci on the pullback itself. Notice the difference. Earlier, we drew Fibonacci on the main rally to find our entry. Now we draw it on the retracement price from the pullback high to the pullback low. In this setup, the 1 level will be at the swing high and the 0 level at the swing low. Our primary target is the 1.618 Fibonacci extension level. This level often acts as a strong resistance zone. However, many traders choose to book partial profits at the previous swing high. A smart approach is to take 50% profit at the previous swing high and let the remaining 50% run toward the 1.618 extension level. This way, you secure profits while still giving your trade the opportunity to capture a larger move. Now you understand how Fibonacci retracement can help you plan your entries and how Fibonacci extension can help you manage your exits. Before we wrap up, let's talk about 3 common mistakes that almost every beginner makes. Mistake number 1. Drawing Fibonacci on every single price movement. Many beginners apply Fibonacci to every small move they see on the chart. But Fibonacci should only be drawn between clear and significant swing highs and swing lows. Mistake number 2. Entering a trade the moment the price touches a Fibonacci level. Many traders assume that as soon as the price reaches a Fibonacci level, it will instantly reverse. But that's not how the market works. Always wait for confirmation before taking a trade. Mistake number 3. Trading against the trend. The main purpose of Fibonacci retracement is to help you find better entries in the direction of the trend, not to predict reversals. If the market is in a strong uptrend, focus on looking for buying opportunities. Finally, always remember one important thing. Never rely on Fibonacci alone. Fibonacci works best when it's combined with price action and candlestick pattern confirmations. Without confirmation, even the best Fibonacci levels can fail. We've already made a dedicated video on candlestick patterns, so make sure to check that out on our channel, and we'll be uploading a detailed video on price action very soon. If you found this video helpful, don't forget to hit the like button, subscribe to the channel, and turn on the notification bell so you never miss our upcoming trading tutorials. Thanks for watching, and I'll see you in the next video with another important trading concept.